孙中山将大清银行改组为中国银行，那一刻，以中国之银供中国之用的梦想便陡然而生，为社会谋福利，为国家求富强，成为振兴民族金融业的使命担当。那一刻，中国银行不畏强欲，坚守信诺，以宁可行路吉人，不肯苟且从命的勇气，只愿为国家维持一份元气，为人民留一线生机。那一刻，中国银行跨越山海，上下求索，只为探寻一条建设现代化、国际化大银行之路。在世界金融业的舞台上，从此有了中国人挺立的脊梁。那一刻，中国银行以人人当具为国牺牲之精神，以先国后行、勤勉努力的信念，穿越纷飞的战火，迎接胜利的曙光。五星红旗飘扬神州大地，打破条框，迎难而上，积极投身社会主义建设的伟大事业，筹集外汇，支持中国远洋运输和外贸经济全面发展，在动荡中前行，在迷茫中寻找方向，冲破封锁和孤立，搭建起新中国与世界互联互通的桥梁。当改革开放和现代化建设的号角吹响，敢想敢为，善作善成，让金融活水浸润民生的每一个角落。从第一张银行卡到第一台 ATM 机，从首家入选世界500强中国企业，到发行港币和澳门币，为港澳金融稳定贡献新的力量。从国内首家 A+H 上市银行，到中国唯一的双号银行，从成为首家入选全球系统重要性银 为中国唯一持续经营超过100年的银行，在民族金融史上书写下中国第一与唯一。在前行的道路上，不断续写新的华章。新的时代，新的征程，秉承融通世界、造福社会的使命，登续奋斗，勇毅前行。以国内商业银行为主体，全球化、综合化为两翼，奋力建设全球一流现代银行集团，在民族复兴的道路上，描绘着新的壮美画卷。今天的中国银行全球化版图不断扩展，境外机构遍布全球60多个国家和地区，形成了覆盖40多个国家的“一带一路”金融大动脉。今天的中国银行综合化平台日臻完善，投资银行、直接投资、证券、保险、基金、飞机租赁、资产管理、金融科技、金融租赁，为客户提供更加多元完善的金融服务，发挥国内国际两个市场优势，支持国内大循环建设，畅通国内国际双循环，服务高水平对外开放，是中国银行辉煌历程奏响的时代乐章，支持实体经济发展，满足人民对美好生活的向往，为推动构建人类命运共同体贡献金融力量，是中国银行筑梦征途上镌刻的铮铮誓言。浩渺行无极，扬帆暗信风。
你爷1958年从上海东航过来，参加了咱们这个银川分行的筹建。爷爷我，咱们中行3代人。
改革开放以后，好多生意人用大马袋装着人民币做生意，所以说信用卡是各个行业，尤其是生意人员，甚至是说这个青年都非常期待的。
香港是我们祖国的土地，要让英国来管制，这样的处境什么时候能完呢？
这个时候，香港不是香港，香港就还一分钱都还是有。
回顾我这一生最重要一个经典，就是能够参加到香港的回归工作的全过程。我从20多岁参加工作，也是苦苦等了几十年了，难以形容的心情。
10年之前，中国银行已经进入到全球10大顶级的这个银行之列，对此呢，我感到非常骄傲。
我作为一名小语种的毕业生，能够用自己的专业架起中行连接世界的桥梁，
我骄傲，我骄傲，
我骄傲。
我骄傲，我是中行人，祝中国银行的事业蒸蒸日上。
这面旗子越来越闪亮，能够实现全球服务的梦想。
我感谢中国银行。
祝中国银行110周年生日快乐！
Hi, Chin. Good to be here today. With pleasure.
Great to have you, Oscar. And Bernard, the co-founder and partner of SmartLabs.
I think thank you for having me.
Pleasure to have you, Bernard. And Jeff Chen, Senior Vice President of Plug and Play.
Thanks for having me. It's great to be back in Beyond 2022.
Awesome to have you back here. So, let's just get right into the conversation then. We all know this, and the past year has been a challenge to a lot of businesses, perhaps more so for companies that are just starting up. So the first question I have is, what is the environment for startup fundraising right now? Are there any sectors and regions that are more attractive than others, and why? Yes, I'll start with you, Oscar. And everyone is welcome to chime in.
Well, I'll say that that is no secret that fundraising has not been easy during the last month. I mean, we've been some of the numbers in terms of investment hitting really the lowest in years or quarters. And that is an objective fact. But if I have to describe the situation in terms of fundraising for startups right now, I'll say the word is slow. I mean, we work very closely with a lot of our portfolio companies, and we work with companies really across the world. I mean, for all these startups, we're based out of Shanghai, but we're investing globally across multiple parts of Asia, Africa, Europe, North America, Latin America. And the common pattern that we've seen is that the decision-making process for any investment is taking longer. Every investor is scrutinizing more all the decisions. I think a lot of investors, at the end of the day, investors, we also have to report. Most of the investors, especially VCs, we have our own investors, our own limited partners that back us, and we need to explain, okay, what did we do, what do we do, and potentially leave like a clear evaluation process. And those evaluation processes right now are probably more detailed than they used to be. So everything is taking more time than it used to take. Financial due diligence are becoming way more tough. A lot of investors, they're trying to understand better. They used to be a stronger focus on growth, a stronger focus on the basic, more qualitative elements of an investment. And right now, I think a lot of investors are trying to analyze, okay, how real is what this company have, how repeatable and scalable is this revenue, how solid is going to be this company, and how dependent they're going to be on capital, how far is their own break-even point in terms of the investment, and if they reduce the pace of investment-driven growth, can they still be sustainable?
Right. Is there any kind of sectors and areas that you think that's kind of more recession proof?
Well, I mean, in terms of sectors, at the end of the day, every time there's a change in the global economy, in whatever aspect that exists, there's winners and losers. So some type of recessions, for example, they will drive. I was talking yesterday with a couple of my portfolio companies that are growing really fast and they're actually having almost runs. And the common pattern for all of them is that they are a better, cheaper, faster solution in the enterprise space for existing mandatory needs or mandatory requirements that a lot of companies need to have. So one of the things that you need to look is, okay, am I a nice to have or am I a must have for my customers? I'm assuming that I am a must have for my customers. If you're a nice to have, especially for the enterprise and B2B space, a lot of people are going to say, sorry, like maybe later. And probably for consumers, it's gonna be similar. Families that need to evaluate their own, how they spend their resources, considering the global uncertainty, they are gonna make that decision. And if you are a must-have type of service, how do you compare with the existing alternatives? The price sensitivity is probably going to be more relevant, but also with certain aspects, like health, people will not compromise as much on health as they might compromise in other aspects. So in that case, can you also prove that you are not just cheaper, but better or easier than the existing solution? And from that point of view, migration or your capacity to ease the path of changing is going to be important in that case. So we're seeing a lot of movement in terms of financial services. There's a lot of people, a lot of organizations where they see financial services as a foundation of a lot of organizations, thinking, okay, this is an area where we can improve. This is an area where we need to look at those details where without any change in our business, we can reduce our expense or improve our profit. In terms of geography, I'll say that for us at Orbit Startups, we have a very strong exposure to emerging markets. Although we invest globally, it is true that Asia, Africa, and Latin America are areas where we're investing stronger. We were originally as Orbit Startups coming from China Accelerator, the first program, physical program ever launched in Asia. We take a lot of the Asia innovation coming from China, from India, from Indonesia, and now circulating. And we see in some of these markets less impact in terms of the fundraising environment as we've seen in other markets, like for example very strong reduction, at least in the portfolio that we have exposure to. This is something that is actually an exception. Anything that is climate tech or carbon reduction related is actually the opposite. We haven't seen any change there. Actually, there's a lot of growing appetite in that area. And then Europe has also been very, very slow. I'm right now in Spain, Europe, connecting a bit more with the local investment ecosystem, and I've seen also across Europe a very strong reduction in terms of the activity. So I'd say emerging markets are still, I mean, traditionally we've been different in terms of the pace of investment and activity of investment, but we're seeing less reduction compared to what we've seen in other more established markets.
Sounds good. Yeah. Financial services, climate tech, sustainability tech, and emerging markets. Cool. So a similar set of questions. Bernard, would you love to hear kind of what's your take on it?
Yeah, I mean, not to be redundant with what Oscar said. I would just add sort of like, this year, I think it was expected from a lot of people that saw similar cycles before that this year, at least valuations are reasonable, especially at the seed and Series A stage. I mean, across all stages, but especially, the updraft that was created by Tiger Global, Maverick, and all these players last year, created like outrageous valuations at the seed, especially, here in Silicon Valley, where I'm based, where companies that typically would be like 8 to 15 million pre, especially if they're from, the YC class, it would be like 20 to 15 million post money. And unfortunately, we did do a couple of those deals, but it was just sort of like outrageous. We knew that there would be adjustments this year, and then we were just concerned if it was a small seed raise, which we didn't participate in those. If it was like 2 million, even on like a post of 25 or 30, they would have a real hard time once there's a downturn, there's an adjustment in the rounds. So at least sort of, rationality is sort of back this year. So I think that's good, for investors, but also for entrepreneurs, right? And for them to also see this cycle and just realize it's not always about, the highest valuation. It's really about executing with what you have and also hitting your next sort of benchmarks and goals. So
Right. So more reasonable valuation this year. Do you see any kind of opportunities in this kind of adjustment period?
well, I think if we saw some of like there's certain types of entrepreneurs that might have been just going for like a quick money grab. I think it also filters out any bad actors in certain spaces like crypto.
right? So I think it's a good thing for the overall ecosystem to go through this period of adjustment for also for first time entrepreneurs to sort of see this cycle. So I think it's been a good year overall.
Yeah, healthy adjustment periods. Cool. So, Jeff, I want to turn the table to you. Would love to hear what you think on that.
Despite all the negativities that we've been hearing in our industry last year, I would say 2021 was a very solid year for a lot of funds, especially ones in Silicon Valley, right? I think a lot of startups, especially ones that are kind of taking advantage of COVID, saw everything moving on virtually, they're doing really well. And then last year was also a very, very solid year for the venture capital firms. But I think just feedback around what was shared earlier, this year's been definitely been very, very tough. Be hearing across the board, startups are becoming more and more conservative as with investors. In terms of the opportunity, areas of growth that you mentioned, I think one thing that we've been seeing is the domestication of product, right? I think, especially with some of the heightened political instability, I'll put it that way. We've seen a lot of growth in that, as you play work with a lot of the Fortune 500 in terms of innovation, introducing startups to them, and we've been noticing that they've been requesting these type of startups from us. Is that the Siemens of the world, for example, in China, they'll kind of purchase the equipment, but then in terms of the software that operates it, they're now looking for something that's domestic, right? As opposed to just looking for the best available technology. So that area we've been seeing some trends. Cybersecurity, we're also starting to see a bit of a comeback in that area as people start to pay more attention to that. Carbon neutrality has always been, solid. So these are some of the areas that we've been seeing some growth. And I was just in Silicon Valley last month, and then started that we invested into is something that wouldn't be as sexy, I would say, 2 or 3 years ago, but it's actually very, very solid right now. It's I could say it's just sort of like a Chinese version of touring, if that would be a good idea. So it's basically like an HR software, outsourcing global needs to cheaper, more efficient talents globally. This is something that wouldn't really get everybody's interest, I would say 2 or 3 years ago, but right now, with a more conservative investment mindset, and then COVID, everything turning virtual, these are some really solid investment that we'll be seeing actually.
Yeah, right. So kind of more domestication of different kind of offerings, cybersecurity, carbon neutral. So, since we're having you here, I'm gonna switch the order a bit. And I'll pose the next question, starting with you, Jeff. So, we've been hearing a lot from all of you guys that we're in this kind of adjustment period. And as we're finishing off the rest of this year and heading to the next one, we're probably going to see a period of continuation of this adjustment in many regions, and some might even face kind of the threat of recessions. So we would be curious to know, what is your investment strategy for the next 2 years? And how long do you think we're going to be out of this adjustment period?
Sure. In terms of the overall strategy, what I would say is that my team and I have been focusing a lot more on not just the founding team of a startup, but also just really digging into the business model, which is something that we don't do as frequently because we typically invest in about 250 startups a year. So that's a lot of these to do, obviously. But then I think one of the speakers, I think Oscar mentioned a little bit earlier. Now we are not just talking to the founders, seeing that solid background. It's really about whether they're really they're really taking care of some real pain points. So I've been asking my team to pay a lot more attention, to doing a lot more due diligence. And this is something that we don't typically do. For early stage startup, 100K check sizes is really about, if they have solid background, they have strong traction. So I think people just be, the VC world is going to be more and more cautious. And then we have to make sure that there's actual strong application as opposed to just a very sexy idea or whatnot going forward. So that's part one of your question. Part two, in terms of the adjustment period, I typically would not like to put an actual length, whether that's 18 months or 20 months. To me, it's more about an adjustment period, right? And then it really comes down to the vertical, the industry, and the region. So I wouldn't say that we're out of the woods in 1 year. It's really about us making an adjustment, from investor or startups, right? So I think really, it really varies from that point of view. At least from my firm's point of view, we're mostly focusing on the needs of corporate partners. So the startup that we're looking at are mostly 2B startups. It has really been about cross-vertical support. That has been kind of the focuses for a lot of our corporation. They're looking for potential growth outside of their industry, in a sense. So that's what we've been seeing a lot, especially from the financial industry. Banks are really looking at startups from all different sectors, which we think is a very interesting trend.
Yeah, just want to know a little bit more what kind of other sectors that banks are trying to get into.
Okay. So for example, two of our biggest partners, one is providing income, right? That's Pudong Development Bank. So they started an in-hub with plug and play, and then surprisingly, they're not targeting fintech startups. They're looking at fintech plus, right? So fintech plus retail, fintech plus health, and then they're really looking at how they can leverage their client base using their technology to expand to other industries. And then the ones that are looking at fintech right now, surprisingly, are the OEMs in tier one. We see that the big car makers now they're looking at fintech and they're looking at health application. So all these things are something that starting to become more mainstream post, I would say, 2019 and 20, is that we're getting requests from corporations that are basically out of their typical comfort zone.
Very interesting. So yeah, more careful due diligence and cross-sector projects. Right. Bernard.
I'm sorry, could you restate the question again?
Yeah, for sure. Just what is your investment strategy for the rest of the year and kind of the next 2 years? And how long do you think we're going to be out of this adjustment period?
Well, markets are hard to predict, right? Even on a personal level, on the equity side, it's like, when is bottom? Well, it looks like bottom now, right? So, I think the only thing we can do is, obviously give advice to our founders in terms of just focus on execution, be a little more conservative during this time, right? And just ride it out and see, when the bottom is. I mean, hopefully it's year end and things will pick up, next year, but, we'll see. In terms of investment strategy and our process, it hasn't changed that much. I think we're just more strict on valuations now, right? I mean, I think we, even though we're a young firm, like 9 years in, we still had a pretty standard process in terms of our due diligence and the way that we made investment decisions. The only thing is that I would say we got, sucked into some of the craziness of last year, right? So we're not going for any crazy evaluations, and some of the founders, surprisingly, even in September of this year, they still didn't get the memo. They can't go for these high valuations. So, me or one of my partners has to tell them, I don't think that's realistic.
So that's probably the one thing that's probably changed in our process is walking away from some of the crazy valuations.
Right. So yeah, be more careful on valuations and as founders focus on executions and riding the whip out.
Yep.
Right. Also,
Well, I mean, for us, kind of aligned with what Bernard was saying, we're not, in general, we have a very consistent investment strategy constantly in the way we invest. So we keep our pace of investment, working with companies, because our model of investment, it is somehow quite recession proof. So we always back companies that have core fundamentals, that they are solving real pain points, that are working in a way where there's some level of confirmation that the value that they create for the users receives a compensation. So our companies tend to get to a unique positive economics relatively fast, and they can potentially not just be dependent on external capital to survive, but they do leverage external capital to grow. So from that point of view, that's going to be relatively similar in terms of our investment. I think that what probably are going to see right now is that companies are going to start to work on thinking internally what should be their strategy. So right now we're going to be doing a number of I think it's going to be at least a year, maybe a bit less, maybe more, we don't know, but I think a year is a good time to plan as a benchmark where cost of capital is going to be very high. And that's obviously going to create difficulty for those companies that require capital to survive and to be able to operate. But on the other side, cost of infrastructure and cost of growth is going to be cheaper. So there's going to be more talent available. The talent available is not going to have the same level of expectations. The challenge here is going to be that some of the talent that traditionally that in the past, during the good old years where money was flooding into the startup world, they were more comfortable joining startups. Right now, they might be a bit more conservative, and then in that case, they might prefer to just join a more established firm instead of trying to take a role in startup. Although personally, I think this is actually the best time. If you pick the right, if you pick the right winners, it's actually the time where a lot of good companies are going to be created. You know, we've seen that pattern over and over, where any time where things are slow and the cost of opportunity to launch a company and the established players are more open to change, because no change is a risk. When everything is going well and there's no issue, change is a risk. So if works, don't change it. But if things are not going as expected, then you have to change. So I think from that point of view, that's going to be very important. I mean, one of the key value propositions we bring to our companies is free customer acquisition and free customer development to secure customers. And these particularly for consumer startups, this represents close to 60% of the venture capital that is raised. So if you remove the need to have all of these access, the need to have all of these budget for customer acquisition, and the remaining budget, which is used mostly for team, for product development, this is somehow lower because the market cost is also lower. That creates a very good opportunity for capital efficient companies. So that's why we will not adjust, at least will not adjust our strategy dramatically. We'll continue very, very consistently. We might adjust the way we work with companies because now more companies will probably be more interested in leveraging some of these channels for free customer acquisition that we offer to companies.
Right. So sounds like you're keeping a consistent investment strategy focused on those companies that give society real values, and also seeing opportunities in kind of financial structures and makeups within companies during this time.
Yeah, I'll say that it might be a bit more difficult for companies that have a long time to market. So especially some of the deep tech companies, in that case could potentially be a bit more difficult. But then deep tech companies sometimes they work in areas that might run differently from more like business driven type of or short-term business driven investment. No, we're talking about how or climate tech companies are actually having a good time. There's a lot of investment. A lot of those companies are actually deep tech companies that are leveraging science to solve some of the biggest challenges that humanity has.
Right. Anyways, you were saying that you're seeing still just persistent investment opportunities for those companies, right?
Yeah, I mean, actually, this is a global trend where there's a lot of activity, and there, I think that creates also other areas that season where there's also a lot of activity.
Right. Right. So Bernard, I'll start the next question with you. And the next question is, what is your suggestion to startups that are looking for funding right now? If they don't have secured enough money before this investment period?
Well, I mean, it's hard to sort of generalize it. I mean, it depends on the space that you're in, but I would generally say, just be persistent
I think during this environment, it just takes, probably like twice as many asks and pitches, etc. Right? So if you know, a year ago or so, maybe it took 50 meetings or 50 to 100 pitches, maybe it'll take 200. So I think just be persistent, but also, it's like basic things like know the investors that you're targeting, what they're really looking for, and if if that if that firm has even adjusted their strategy, some have, some haven't. I remember even like last year, some of the established Silicon Valley firms, such as Sequoia, they've turned away these crazy valuations at the seed deal. You'd be like, are you guys crazy? They actually told that to one of our startups that we invested in. Right? So some people, they made the adjustment, and so they should definitely do their homework on this.
Right. Do you have any examples? I mean, you don't have to give specific names, but just maybe like specific sectors or just more examples to illustrate that point.
In terms of what people are looking for or shying away from, I mean, obviously it's, the interest overall in crypto, let's say, has gone down, right? But also some of these businesses that thrived during COVID also are less interesting, right? Whether it's like Peloton type businesses or certain delivery or things that were more stay-at-home oriented, there's obviously been an adjustment. Even just general trends, people assume that there would be sort of a continued enthusiasm towards work at home and not going to conferences and traveling. But I think in the US and a lot of locations, people are dying to go and travel and meet people in person. Right? So these are all things that are sort of swinging back.
Sounds good. Oscar, I'll come back to you with the same question. Suggestions to startups.
Well, I'll say three things that I believe startups need to work on if they wanna like try to fundraise during this time. The first thing would be adjust. You need to adjust your cost structure, your financials. You need to plan on that. And when you finish that, adjust again. And when you finish that, ask somebody to help you adjust. So you need to show capital efficiency. You need to increase runway. So right now, investors want to make sure that whatever they invest is going to do something that has a purpose. So I think that's the first thing that is very important. Okay. Second thing is make the investor work easy. So investors are taking long because they have to analyze more. So make sure that you share information in a clear, organized way. So giving me a data room with a million documents, 3 gigas of data is not helping me if most of this information is irrelevant. So make sure that the information that you provide is simple, but not oversimplistic, is well organized, and is clear. That is very important. And the third thing, and kind of like building on what Bernard said, you need to make sure that you have patience and you understand that this is a process, and that this process is going to take time. So you need to understand who are the investors that you're talking with, what is the activity that they have, try to understand when is the last deal that they made, what are the criteria that they have right now, try to compare what they tell you and what you're able to see in terms of the activity that you can track. If you have existing investors and those existing investors have some intel from the market, try to work together with them. I was checking yesterday with a few portfolio companies, and I was like, well, work with your investors, share with them the data, be consistent, be transparent, and make it easy for people to make decisions. I think that that applies every single time for investment, but right now this is even more relevant than ever, because whatever is nobody likes fundraising. Personally, even when I was an entrepreneur in my own company, the part that I liked the least of everything was fundraising. I like building my product. I like working with my team, thinking, but having to go through a lot of rejection, a lot of conversations with investors, and repeating the same story over and over again is not the most motivational part of being an entrepreneur. But there's a necessary step to be able to build your company. So Jeff, you guys work a lot with enterprises, and one of the things that we normally see is a very specific, different behavior between corporate VCs and regular VCs. What are the trends that you're seeing right now in terms of corporate VC activity that might be different from the regular VCs?
A lot more conservative now, especially me. I'm currently based in China, but then previously I was based in the States. A lot of our corporate partners from China, they're being very adventurous and with some of their investment, with their appetite. They're looking at really earlier stage startups globally just to get a sense of the trend. So I feel like they can probably afford to do that in 1920. But then since COVID, they've kind of pivoted their focus back to their home region, their domestic region, and then they're starting to ask for more mature startup, Series A or after, where they can see some strong education. So that's something that we have been seeing noticeably post-COVID.
Yeah, I mean, we always see like a kind of a reduction of activity in terms of corporate VCs when the core business needs to be the priority. Because at the end of the day, I mean, for regular VCs, or investment activity is a core activity, but for corporate VCs, that's 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 kind of like an extra thing. Is that corporate VC has grown significantly over the last 2 to 3 years, and I wonder, well, there's a moment where corporate VC itself starts having a different and separate behavior. No? And I do think I've seen some funds that I don't see particular change, like a lot of the companies for portfolio companies that are closing around, they actually have more policies working, but that's yeah, I guess that across the board, the behavior at the end is the same behavior for the whole group. And if I can ask another question, maybe to Bernard. So Bernard, and you're based in Silicon Valley, but in Spark Labs, you guys have very strong, like Asian, Korean DNA in what you do. How are you seeing right now? And you were talking about valuations and valuations in the valley being really high, whereas in other parts of the world we don't have that type of like high valuations. What are you seeing in terms of are you seeing like a more interest in like Silicon Valley funds looking at other geographies based on like lower cost or valuations, or you think that these recessions actually like closing things a bit more?
Well, in Korea, there's still some of the high valuations. It's wherever SoftBank and Tiger Global go, and they're investing across the globe. But I think for Silicon Valley firms, yeah, I think if they already invested overseas or in certain markets, I think they just continue that. Again, with just more of a reasonable approach. So I don't think it's like this sudden sort of movement outside of the U.S. or Silicon Valley. But I think it's just a general trend anyways that occurred before the craziness of the past couple of years. I mean, the bellwether is obviously always Y Combinator, right? And every year they've slowly increased their international intake of foreign companies in their portfolio. So you've seen that increase from like 30% to 35% to 40 to 50% every batch. And so I think that's just a good signal for I think all of us here and other investors that invest in multiple geographies is that the world is getting flatter. Entrepreneurs are getting stronger across the board, and there's obviously a leveling playing field too. So I think it's a good thing.
we were before this kind of like situation kind of started to be more clear. I think 3 months ago, and we were actually surprised and gladly seeing a lot of investors from Bali like venturing into some of the markets that we were active. So we were able to see some of the most iconic venture capital or angel investors from Bali investing in our companies in Pakistan, or taking first investments in India or Nigeria, or some other markets. And we don't know exactly if this is something that this change is something that will accelerate the trend, or will potentially slow it down. We're still not clear on that. We don't have enough evidence to be able to say, well, this seems to be the trend.
Yeah, I think it's sort of a wait and see. I mean, for us, like we did actually, in the past 2 months, we did 2 recent fintech investments in Pakistan. Right, so I think people are looking at more emerging markets. You sort of do have to place your bets as everything develops. So.
Right. So kind of just closing up our conversation, kind of wanted to pose a kind of future-looking question. What kind of predominant trends of the early stage investment you guys are seeing, maybe kind of a few years from now? Oscar, let's see.
Well, I'm trying to understand the question, see how to
just kind of the emerging trends that you're seeing that kind of just bubbling up. I think that are just taking shape.
Well, I think at least for us, one of the trends that we're more excited about is actually is one of the pillars of our investment thesis in our opinion, which is right now we're seeing technology as a force of improvement of quality of life in emerging markets. Some of the goals that society has to be able to reach level of stability and well-being. They can only be achieved with the use of technology. We're only going to be able to provide education and health and proper access to food and healthy like entertainment if technology becomes relevant. And I think that's going to be a major trend that's going to be very, very relevant, and we're going to see not only those businesses and those that technology be very relevant for the situation of the emerging market, but what we're starting to see as an initial trend is that those solutions that are very efficient in terms of cost, very effective in terms of solutions, and sometimes they're like very simple to be able to be quite inclusive and require low barriers of entry in terms of knowledge or technology literacy to be able to use them. Those solutions are eventually gonna be able to make a jump and become solutions that are also gonna be quite relevant and quite competitive in more developed economies, where at the end of the day, we're seeing, for example, like case right now of a company providing a solution in the insurtech space that addresses the issue that policy management, the cost of policy management sometimes makes certain insurance services not viable in emerging markets where the premium is very low, and then if the cost of the premium is lower, but the cost of management of the policy is too high, the premium the service cannot be delivered. So you need to have a more cost-effective solution. Once you have this type of cost-effective solution that works and is compliant and meets all the requirements in terms of quality, security, safety, etc., at that cost, that solution is also a solution that could work in a more developed economy. We're seeing already that with some of the portfolio companies. So I think that trend is an emerging trend where we'll see new hubs of innovation that will shape the future, and we're very excited about that, and we're really looking forward to bring more innovation from the rest of the world. Sometimes it's called to more like larger ecosystems.
Right. So tech solutions that improve the quality of life that are taking shape in emerging markets and might spread all across the world. Great. Bernard?
Yeah, I think just general sort of trends that, we sort of see are more innovation on the enterprise software side, especially in even top OECD nations, besides the US, UK, and certain markets. I think that's developing further in Asia, right? Whether it's China, Korea, Japan, I think it'll continue, and also sort of second-tier OECD nations. Crypto infrastructure plays, I think that's going to grow. It's a space that we're watching. Also, just overall healthcare innovations. I think that's going to continue. It was a trend obviously in COVID, but I think it's just further accelerated, whether it's on the biotech side to even just on the software and other innovations.
Right. Jeff?
So I think instead of proposing a particular sector or industry, I would just kind of re-emphasize on the domestication of product and services. What we see right now, 3 years ago, when you find something really good in the States, you would say, well, can I potentially bring that to China? Vice versa. Now the mindset has become, well, I see a very good idea for a explosive startup over here in this part of the world. Can I do something similar in that part of the world, given the policy, some of the political sensitivity and whatnot? So that's what we've been very intrigued to see, and then startups take a lot of pride, just saying that I'm this version of that in this particular part of the world, knowing that there's actually a high barrier since COVID because of some of the political environment that we've spoken. So I think that has also been a developing trend. I think that which will probably continue to the next 2, 4, even 6 years.
Right. It's a good idea, regional idea that are taking shapes in different parts of the world. Right. I think that would be all for our conversations today. Really appreciate all you guys making your time to give us all those insights. We benefit greatly from them, and thank you so much for sharing those with us.
Thanks for moderating.
Thank you.
Television station. I will be hosting this session, and may I first of all introduce our two guests. They are Sir Danny Alexander, Vice President of Asian Infrastructure Investment Bank, also known as AIIB, and Leslie Marstorp, Vice President and Chief Financial Officer of the New Development Bank. Welcome.
Thanks for having me. Thank you very much indeed. It's good to be here.
All right. Basically, we outlined 6 questions, and I'll finish off in 45 minutes. Please talk freely, have a lot of interaction, and I might not follow the question exactly as, the wording and emphasis. I might have a lot of questions in between. So let's just sort of, chat along and to see, the sparkles in between. All right, so very first question is, how has technology changed the strategy of infrastructure investments? Danny or Leslie, who would like to get started?
new types of infrastructure like data centers, 5G networks, telecommunications, grids, and so forth. And that new infrastructure also then helps to upgrade existing infrastructure. For example, turning a grid into a smart grid, turning a city into a smart city, and so forth. And thinking through those infrastructure needs is a critical issue. I mean, in Asia, you see huge digital divides. You see cities and countries with very highly developed digital infrastructure, and those with digital infrastructure, and that in itself is causing economic changes. It's accentuating differences, and so I think part of the strategy has to be to say, how can we help through multilateral development banks like ours? How can we help those on the wrong side of the digital divide with the investments to help them improve, or even in many cases to leapfrog directly to the best, most modern technology. So it means you have to focus on the end users. It means you have to focus on the outcomes. But it also creates opportunities for better efficiency, for greater transparency, to enable infrastructure projects themselves to work much more effectively, to be managed better, for maintenance costs to be reduced, and so forth. And so, actually, technology affects every aspect of infrastructure development.
Yes, please.
The energy system, for example, we're focused on energy, and technology changes all of those things.
Leslie, would you like to add anything?
Thanks very much, Jesse, for having us. Just to complement what Danny has already highlighted, I think the first point I'd like to make is that multilateral banks have a very unique and critical role to play in the transition to net zero, to draw on the best of what new technologies offer to reboot infrastructure throughout the emerging markets, and by the way, in the developed world. As you know, we are currently in a process, a long structural set of changes in the global economy, and the financial sector has a pivotal role to play to enable that transition. So every sector, as Danny has highlighted, whether it be energy, whether it be transport, logistics, every sector is undergoing significant changes in the business models. And what we are trying to do as MDB, AIIB, New Development Bank, World Bank, and all the other major multilateral development banks, is to be a catalyst for that change. The kinds of change required will require significant investments in new infrastructure. Let me give you an example. I come from South Africa, where our energy grid is more than 88% based on coal-fired power stations. We have to build new energy infrastructure, if you like, but at the same time, we have to have a more appropriate energy mix in terms of renewables, whether it be wind, hydro, solar, and so on. And as Daniel also highlighted, there's a significant opportunity now for developing countries, for example, in Africa, the continent where I'm from, to leapfrog in the sense that we can skip a generation of technologies and adopt the best that is on offer today. So the technology is probably the most exciting element of infrastructure investment today, because we are moving away from business as usual models.
Yeah, exactly. It's just like technology has changed everything a lot. So when I was young, when I was talking about infrastructure, my mind was building roads, bridges, just basically have cars running on something, so that we can be connected. But now we're talking about infrastructure. It's a lot more than just concrete roads and buildings. We want to build smart cities. We want, as Leslie said, we want to go sort of go through the next generation of having a lot of high tech in it, so that it can be more sustainable for a longer time, and it can be user friendly as well. So based on that, so how are our new strategies affecting economic and social transformation? Because as we already mentioned, a lot of Asian countries are actually going through social transformations. Well, for example, say China, we have moved from labor-intensive industries into a lot of high-tech, new energy, AI industries. But some of the developing countries in Asian countries, maybe they are not that ahead. They're still in an area that they still need roads and bridges built. So it's not very even in Asian countries. So how the new energies can help them accordingly?
You are on mute at the moment, Danny.
I can go first if you like, and I'm just picking up what Leslie's point, and then you mentioned roads and bridges, but roads and bridges are still needed, right? And they will always be needed, unless we take to the air somehow. And then some other kind of infrastructure will be needed. But technology changes those roads and bridges. It changes the way that you operate them. It changes the way you construct them. It changes the way you monitor and maintain them. It changes the type of vehicles that you can use on them, and roads with sensors built in to monitor the traffic, with electrical charging built in to enable new energy vehicles. So many applications to technology there, and that's what's referred that's what's referred to when we talk about infotech. And infotech is really at the, I think, is at the center of the political agenda. You know, given all the challenges that we're facing in the world today, fiscal, inflationary, liquidity constraints, the need for governments to bridge infrastructure financing gaps with less spending. Infotech also offers a kind of supply side solution to bridging the infrastructure financing gap. It helps us to build the infrastructure with less and better. It helps us to manage the maintenance costs much more effectively. It helps us to get much greater spin-off benefits for other aspects of society. And so I think that the application of technology to traditional infrastructure is critical to how we affect the social and economic transformation. So just one example, our teams were working on water and sanitation projects in Uzbekistan, introduced technology that is perhaps commonplace elsewhere, which helped to reduce the cost, helped to improve the operation of the system, and also gather data which was of use in the healthcare system, for example. And so in that way, you get more benefits from your infrastructure. And of course, in the COVID-19 pandemic, we've also seen I think the vital role of technology and technology investment in helping society cope with one of the most kind of traumatic crises that we've seen for many decades. And in that way, helping economies to recover more quickly, helping people to manage the difficulties they're going through, helping communication about how people can handle different situations. And so again, those countries with good technology have been better able to weather that crisis than those without, broadly speaking.
Lastly,
just to add one or 2 points to what Dennis really highlighted, and I'd like to pay particular emphasis or draw and really shine a bright light on the fact that the need, the demands for new sustainable infrastructure in emerging markets is distinctly different from that of developed countries to a degree. And here I want to make reference specifically to the fact that developing countries have a different historical disadvantage. Firstly, because let's take Africa, for example, and parts of Asia, were industrializing at the time when emissions matter, when coal, the pricing of coal matters, during the time when the advanced countries industrialized, United Kingdom, Europe, the United States, and so on, carbon emissions was not front and center of the consciousness. And therefore, it's important that we ensure a sort of a fair and a just, and you can call it even an equitable transition. The world is never sort of fair and equitable, but we have to put in place elements as we move towards on this sort of path of upgrading our
the total amount increased from 2.8 trillion in 2018 to 9.3 trillion Hong Kong dollars in 2021. So that almost 3 times compared with the past. I think I just want to, the last piece is about to share you with the latest development and good news. So early September, Vice Chairman Fang Xinghai of CSRC spoke at China International Financial Annual Forum and announced 3 new measures to strengthen Hong Kong's position as IFC. So, which is like the inclusion of Hong Kong listed international companies in Southbound Stock Connect, as well as the expanded inclusion eligibility for Northbound Connect. A second is the support for RMB-dominated counter in Southbound Stock Connect. And last is the launch of Treasury bond futures. So I think those are important milestones that build on further attractions of Hong Kong as the IPO market.
Great. Thank you so much, Winnie. So, so Joe, as Winnie kind of was alluding to, it does seem like there's a lot of kind of 2C companies from China that are choosing, that have in the past chosen to go public, especially from the technology industry. And as we heard as well, it sounds like some of that might be changing as we kind of come into the end of 2022 and maybe even going into 23. So how do you see the trend in terms of Chinese tech companies or maybe even just Chinese companies in general going public? Do you see that that it's mostly for still kind of in retail, like digital retail, e-commerce, or are we seeing different trends beginning to emerge?
Yeah, thanks. So look, I think if you look at this from a market appetite perspective, right? Investors' appetite definitely do change from time to time, right? If you look at the valuation for a lot of the 2C business model type company, right? Either in the Hong Kong and the US, the valuation actually has come down by quite a fair bit. Including those listed in Hong Kong or in the US, right, in the last couple of quarters, on the back of certain policy changes, right, in China, as well as the interest rate hike, which has actually impacted the valuation for growth stocks, globally. So, and I think recently, right, when we speak to investors, I think a lot of them are actually focusing more on certain thematic industries, right, that is more in line with the government policy, right? Some of these are such as, energy transition, right? New energy, as well as certain, supply chain company within the EV supply chain, supply chain cycle, as well as certain industry that has higher, earning as well as cash flow visibility. So I think, investors in general, they always wanted to follow on all these thematic stocks, right? So I think it actually changes from time to time. Yeah.
Okay. And so what about like things like, like the hard tech? I mean, if we look at the Chinese technology industry, again, like we do see this kind of macro shift kind of taking place, where like in terms of like venture capital, let's say, a lot of the growth was in the retail space, in the 2C, retail customer space. But what about things like, SaaS or hard tech? Do you see kind of early stage signs that we're going to be seeing more of these kinds of companies trying to access the global capital markets, maybe in the next 3 to 5 years?
Oh, definitely, right? Because if you look at in the venture capital space, there has been a lot of these hard tech company been raising capital in the private capital market, right? And a lot of them is actually at the valuation where they are actually IPO ready. So I guess it depends on, first of all, it depends on the market sentiment, and at the same time it also depends on whether different stock exchange will have different listing requirement for these hard tech company, right? Say for example, in the US, I think they are relatively more relaxed, right, in terms of in terms of the listing requirement for these hard tech company. And obviously the Hong Kong Stock Exchange has been making a lot of progress, right? And with the new consultation paper out there, I think it will definitely create a lot of, I would say, inbound demand, right, for these hard tech company to list in Hong Kong as and when the new regime is ready. So yeah, there's hard tech is definitely one wave of IPO candidate that we are seeing globally, in Hong Kong and in the US.
Okay, great. Thank you so much, Joe. So Alan, one of the things that that comes up a lot these days when we're talking about the financial markets, and especially here in Hong Kong, is ESG. So kind of corporate social responsibility around environment and these kinds of green initiatives and sustainability. So so can you give us a bit more background in terms of, from a financial investor perspective, why is ESG becoming more mainstream, and how is this kind of creating challenges or perhaps helping companies when it comes to going public?
Oh, thanks, Troy. I think this is a good question. I think ESG is one of the, as you say, it's one of the hot topics in the market. It's not just a local, it's a global, it's already on a global agenda. ESG has become an increasingly important investment area for the global investment community. Indeed, according to a Bloomberg study, global ESG assets are set to exceed $15 trillion by 2025. And this is equivalent to more than 1/3 of the projected AUM by that time. Even for example, in Hong Kong, I think, just in the first 6 months of this year, about 15 of green and ESG and sustainability linked bonds are listed in Hong Kong, raising totally around 117 billion Hong Kong dollars. So this definitely is one of the key topics and key areas that the global investment community have in eye. And also another key point, like say in China, the Chinese mainland government has set its 13-16 targets for decarbonization, which also drive the importance of ESG in the market as well. That's why we will expect there will be more ESG companies coming up, and will drive more potential listing of ESG companies in the future. Regarding the challenges that you mentioned, as I can say, as ESG has gained the popularity in the global capital markets, the professional investment community is now more familiar with the business models of these companies, the investment products and portfolios, and also impact the value of ESG on the company's valuation. So this should be the factors that should be considered during the IPO process. But however, for ESG is relatively new to quite a number of retail investors. And in a market like Hong Kong, even mainland, which is still quite dominated by retail investors, it might take more time for them to understand and get familiar with the business models of these companies and the impact and the related investment risk. And also right now, I think the market does not have many of these ESG companies with their shares get listed yet. So being able to identify comparable peer in the secondary markets to conduct a valuation exercise for those potential issuers will also be challenging. This also means that there still remains some uncertainty about how these companies or ESG elements will be valued when they go public. But of course, on the other hand, if we talk about ESG companies, if since there are not so many ESG companies listed in the market yet, there will be this actually another opportunity for these ESG companies to take first move advantage, being the first batch of ESG companies get listed. Yeah, this helps. Thanks.
So, Joe, just coming back to you for a minute. So on the one hand, as we heard from Alan, there's increasing investor interest. Well, perhaps retail investors need a bit more education and time to get up to speed. But at the same time, Hong Kong does have ESG disclosure rules that are going to be coming into effect in just a few years. So what's your evaluation of the impact of that disclosure rule change? How do you think it's going to affect which companies decide to go public and or even stay public? And how are you working with companies to prepare for this change?
Yeah, look, so my view is that I think with the new ESG rules, right, on all these new disclosure requirements, I don't think it will impact the type of the company that will be qualified to list in Hong Kong, right? Or people's willingness, right, to list in Hong Kong. Because overall, if you look at the Hong Kong market, it is, I agree with Winnie, right? It is definitely a very internationalized market with, ample liquidity, right? So I wouldn't think any kind of incremental ESG requirement would actually impact the issuers' willingness to come to Hong Kong as a start. So, and therefore, I guess, in terms of the types of company, I don't think that this will create any change to the kind of the industry mix, as well as the geographical mix, right, of the listing applicants that we see here in Hong Kong. But one thing I do think is important is that I think all the listing applicants, right, will probably need to have a very strong ESG mindset, right, as part of their corporate governance, because at the end of the day, a lot of these disclosure are actually, basically disclosing what you have done, right, in order to promote the ESG concept. But what's fundamental is actually what are the corporate governance that the company has in place, actually, to ensure the company is comply or have I would say to fulfill the international ESG standard, right? Say, for example, there has been one article that I have read written by the stock exchange, right? Is that if you look at the percentage of single agenda listing applicant, right? Single agenda board listing applicant, and the percentage has actually come down from 30% in 2019 to only 12% in the first half of 2021. So I think overall, right, people who wanted to come to the Hong Kong market is already aware the importance of fulfilling certain ESG requirement. So I think people are well aware of that, and we are making a lot of progress. So at least from my end as an underwriter, we don't feel it creates any difficulty for us to pitch, our client to list in Hong Kong versus, other markets.
Okay, great. Thank you so much. And so Winnie, just back to you. So again, kind of keeping on the ESG theme for a minute. What is Hong Kong or Hong Kong Stock Exchange doing to attract more ESG related companies to list here?
Yeah, so as a regulator, we have been promoting ESG among our over 2,500 listed companies. And we have introduced the corporate governance code for more than 20 years to reach the corporate governance level among our issuers, and continuously review the code to ensure best practices and up to the international level. So following a public consultation in December 2021, we published the conclusion of the review of the corporate governance code to strengthen board independence and promote a better boardroom gender diversity. And we also introduced the ESG reporting guide back in 2013 and revised the guide in 2020 to require board's ESG commitment and disclosures for all environment and social KPIs on a comply or expand basis. So this elevates our ESG level to the board level. We also provide detailed online director training program and guidance materials and webinars about ESG to help our listed companies to build a more sustainable business sense and put their ESG principle into practices. So above measures continue to upgrade our quality of the market and also shows our focus on building a sustainable business and investing for the long term. So we have already welcomed some leading EV brands to list here in Hong Kong, for example, Xiaopeng, Li Auto, Neo, etc. And we are seeing more from the sector and the industrial value chain, including the upstream players to the component players to list. We think you will see more ESG related issuers to come listing in Hong Kong as soon as later this year.
Okay, so we're almost out of time. But before we go, I think what would be really great to hear from each of you is some of your best advice to our audience in terms of what to pay attention to. So in your opinion, what are some of the one or two pivotal factors to consider before even starting the going public process? Alan, why don't we start with you?
Okay, thanks, John. I think my piece of advice is plan well ahead and prepare well, because I think from my angle, listing is IPO is just is the beginning of a business. It's not the end of a business cycle for a company, and it's always we talk about for a company to make the call to start the IPO process. I might suggest is always go back to their IPO readiness, how ready they are, and their business model. What's the how it helps, how the IPO can help them to make those achieve their business objective. Going properly is a complicated, I can say. It can be a lengthy process, but very rewarding. And very often companies might underestimate the complexities and challenges and the preparation that they need to go through before going public. And once they start the process, they will realize, oh, there are so many details are needed, and they're missing so many details, and there are lots of areas that they need to fix before they are able to comply with the listing requirements. And as such, we will strongly encourage them to do some health check and identify any deficiencies that they need to address upfront. My piece of advice is plan well ahead and prepare well and get the right professional team for advice and guidance. Yeah, that's my input.
Great. So Joe, quickly, I suppose, what's your best advice? What are some of the 1 or 2 pivotal factors that companies should think about before they start the public process?
Yeah, look, I think kicking off at the right point of the life cycle in the company's business development is very important, right? Because like what I've mentioned earlier, I think IPO, right, is just the first stage of any quality company, right? So I guess what's important is to make sure after after IPO, right, there are enough growth potential, growth catalysts, for investors to share the upside of the company's growth, right? So therefore, timing or the point of IPO kicked off is very important as as part of the I have repeatedly say the right point of the life cycle for a company. So I think that's very important for to make sure that everyone has the upside.
Great, thank you so much. And Winnie, last but not least.
Okay, thanks, John. So first, I want to state that Hong Kong Exchange welcome any company that meets our listing requirement to apply for the listing in Hong Kong. So the 2 pieces of advice first is to build up a very stable communication channel with regulator is very important. And here in Hong Kong Exchange, we have a dedicated team from listing division and marketing division to facilitate regulatory compliance and the market education on listing. And second, as Alan and Joe mentioned, I think the company should perform their own due diligence and position in the interested market. So before launching the IPO in Hong Kong, so issuers would have to undergo at least 2 months due diligence check with their sponsors and other professional advisors who will take care of the matters related to their business, accounting, legal, compliance, etc., and make sure the issuer can fulfill our listing requirements. So in addition, they have the option to make pre-IPO inquiry with our listing division, which is free. And this is the option process to seek guidance on case-specific listing rule issues. And last, extra advice is to pay attention with your shareholder communication is very important. So yeah, back to you, John.
Okay, great. Thank you so much. And Joe, Alan, Winnie, again, thank you so much for taking the time and sharing your wisdom with us today. And thank you again to everyone in the audience who tuned in. Bye-bye.
Thank you. Bye-bye.
Thank you.
Bye-bye.
Bye-bye.